Africa's second biggest supermarket chain, Pick n Pay, reported a 16.3% fall in annual earnings, hit by costs related to store revamps and unprecedented power cuts. The retailer said it incurred an incremental cost of 522 million rand for diesel to run generators in the year, and also incurred planned costs in implementing its new growth strategy, which includes revamping old stores and adding new ones. For more on this, we are joined by Pick n Pay CEO Peter Boone. Peter, thank you so much for your time. Let's look back at the year that was for Pick n Pay and what you would say were the bright spots in these earnings.
Overall, if you look at the last 12 months, and if you look at our underlying performance since we announced the strategy May last year, I'm quite pleased on the progress that we have made on the different building blocks. And I think that's reflected in our underlying profit before tax improvements. If you would take out load shedding, we would have been able to see an improvement of our earnings with 7%. And that is the backlog whereby we guided the market that we don't expect meaningful earnings in a transition year, as we call. I think going more into detail, I think our growth engines, be it Boxer with the opening of over 60 stores, our clothing business with the opening of 60 stores and more than double the amount of new store openings compared to previous year, are clear indicators that we are on the right track. Extremely pleased as well with the further penetration in our omni-channel part of the business, whereby especially our online on-demand is showing a triple-digit growth factor versus last year, but as well as our efficiency improvements. And I think that's clearly demonstrated when it comes to the cost savings that we have been able to realize in Project Future of 800 million. And if then zooming into the core part of our business, Pick n Pay, which is 70% of our business, the decoupling of the brand into Pick n Pay and Pick n Pay QualiSave, of those stores that we revamped, and that's only taken into account only 25% of our total store estate, the improvements are coming out, and that is clearly being seen in the uplift when it comes to sales, plus 10%. The improvements that we have seen from a traffic, 7%, basket growth of 9%, but also clearly what we have indicated as power and traffic categories with the double-digit growth. But again, as stated before, it's a multi-year plan. Patience is required, but the underlying performance is steady and we are exactly on course. But we also have to accept we are dealing with what I call the new reality, and you expressed it. Our profits have been impacted with the impact of load shedding, and we spent over 500 million in extra diesel cost as a consequence of that. And we have to deal with this new reality. I foresee that the situation will not improve going forward. And stated to some of your colleagues earlier, is it's not if stage is going to occur, much more when stage 8 is going to occur, and that will have further impact on consumer sentiment, but as well as when it comes to stock supply into the country and availability of goods, and that is something we unfortunately already see in certain categories.
Right. So you have your Ekuseni strategy, which was launched in May last year. And as you mentioned, there's a lot of headwinds out there. You've got a consumer that's under pressure. We've got load shedding that's not going away. Have there been internal discussions about the Ekuseni strategy being slightly tweaked to accommodate the kind of environment that we're in that's rather uncertain? Well, in a market like this, where you're dealing and load shedding it is today. Last year in 2021, we were dealing with the impact of the riots. You need to operate and be agile, and I think that we have been able to demonstrate. For this year as well, is we have said is we continue on the trajectory, and so confirming that we're going to further accelerate our growth engines and the further rollout of the rejuvenation of the Pick n Pay brand, but also that we said, okay, listen, we give a little bit more flexibility in relation to the capex allocation that we give to the different parts of the division, and we have reserved 200 million rand when it comes to further implementing our energy resilience plan, because that's needed and that is required in order to keep the lights on, in order to ensure that we are able to contain cost in a challenging environment in which we live all together.
Is it too soon to talk about recouping costs given the amount that you're spending on load shedding and running those diesel generators?
Well, our energy resilience plan is compromising on a few things. Of course, is doing things smarter, and that is, for instance, the way we buy diesel. Subsequently, tighter cost control in our operational part of the business, but also implementing what I call lighting in our stores in a more what I call economic friendly way. But you have to understand that in an average retail store, roughly 50% of your total energy bill goes to refrigeration. And also there we are looking into new solutions. And we're looking into as well as what we call battery savings programs in order to mitigate these kind of things. And I mean continuous discussions as well with landlords when it comes to saying, okay, listen, invest your capital into solar improvements. And for us, the call to the government, and I think my chairman made it very clear as well, is please don't create double taxations. We have requested as a sector, retail sector, to be included on that levy exemption. Unfortunately, again, the retail sector has been excluded, while the manufacturers not. So that bill is being passed on to the retail sector, and thus over time as well to the consumer. The good thing is, if you look at the last 12 months, we have been able to contain our internal inflation below CPI food inflation. But with this uncertainty and challenging environment we have in front of us, you ask yourself the question, to what extent are you able to maintain that?
Right. Peter, thank you so much for your time this afternoon. That is Peter Boone, who is the CEO of Pick n Pay, unpacking the year that was for the company. However, when we look at the market news now, we did see the dollar slip against most major currencies after the U.S. Federal Reserve opened the door to a pause in its aggressive tightening cycle. The Fed raised its benchmark overnight interest rate as expected, but in doing so dropped from its policy statement language that it anticipates further rate increases would be needed. Meanwhile, Asian markets were more upbeat, although trade has been thinned this week by Japanese holidays. China's benchmark index opened weaker as mainland markets returned after their May Day holidays, but rebounded to broadly unchanged view. However, the European stock market and the euro also sagged as investors waited for another European Central Bank rate rise. To talk to us about the latest when it comes to those markets, we are joined by Han Tan, who is from Xfinity. Han, thank you so much for your time. We were expecting that 25 basis point increase from the Fed, but from your perspective, when you look through that statement and I suppose look back at the press statement with the reporters, what were the key standouts for you for that statement?
Yeah, I was actually surprised at how dovish the policy statement in particular sounded, because prior to the meeting, we had expected a hawkish pause, whereby Fed Chair Powell firmly reiterates the Fed's need to keep fighting inflation, right? But, and to be fair, he did try and do that, but markets clearly took it the other way by the removal of that key line that you mentioned earlier. And so now they're pricing in up to 75 basis points in cuts by the Fed before this year is over, which is 3 times more than the 25 basis points in cuts that were expected prior to the meeting.
So one of the things we've been talking about, especially as we head into the ECB meeting as well, is there's been conversations about, central banks and their mandates and the way the fight for inflation has been unfolding. Are you happy with the kind of communication we've received from central banks so far?
Yeah, I wouldn't use the word happy. I think what's clear is that markets have been willing to look past what the Fed has been saying it will do, because all this is set behind the context of the Fed being slow to react to inflation, hence the need for the most aggressive policy tightening cycle in decades. And again, more recently, they were slow in containing some of these financial instability risks, some of the turmoil that we're seeing in the U.S. banking sector now. So, markets and investors are well aware of these glaring shortcomings. So, again, they are taking whatever policy, whatever the Fed says, with a huge bushel of salt. And hence the pricing that we're seeing in the markets, despite Fed Chair Powell insisting that the fight against inflation is not yet done and that the U.S. banking sector is stabilizing apparently.
With that said, then, the next Fed meeting is in June 13th and the 14th, roundabout there. When you look at the U.S. economy, especially the data coming through, do you get a sense that we're still dealing with a robust economy, or are we starting to see signs of softness?
Yeah, so look, keep in mind that this data that's coming in, right, a lot of it is backward looking. So generally, up until this point in time, you're right to use the word that there's robustness or resilience that we're seeing in the U.S. economy. However, we note that with rate hikes, there is a policy lag, right? And so we expect those lags to feed through into the data, especially the jobs data in the months ahead. Of course, we've got the pivotal non-farm payrolls data due tomorrow, and we expect a slight tick upwards for the unemployment rate. So perhaps wider cracks will start to show in the months ahead.
It's quite interesting when you watch that press statement as the Fed chair interacts with reporters. He tries quite hard to push back on any kind of insinuation that we may get any cuts. And given that, does it, well, rather have you had to adjust your models or at least your outlook in anticipation of higher for longer interest rates?
The short answer is no. We like the markets, we remain guided by some of the other indicators that we're looking at, which for now tells us that the Fed may not be able to keep rates as high or for as long as what they're telling us, right? And now, of course, there is the risk of more rate hikes, but that bar is set really high. Granted, inflation may prove to be more stubbornly elevated for longer, but I think what's happening on the credit side with the tightening lending conditions that we expect to find out with a report on Monday, I think that would do the Fed's jobs to a substantial degree. So I think if there's more trouble in the banking sector, that only paves the way for not just a US recession, but Fed rate cuts to offset that potential recession later this year.
With that banking sector crisis, and I know there's some concerns here and there in the market, what kind of questions are you asking yourself at this point as we see these banks go through these tough times?
Yeah, so I think the multi-billion, if not multi-trillion-dollar question really is who's next, right? After the first couple went down in March, then that question persisted. Now we've got 4 banks that have failed, and now rumblings with another one. So I think that's the ever-lingering question. Powell said that we are drawing, we're a step closer to drawing a line under the sand here, but markets clearly think otherwise, given how the equities or the share prices of some of these smaller regional banks are performing right now. And so, if there is a next one to fail, then markets will then ask, what is the next, or how wide will the contagion be? Right, because you already had J.P. Morgan stepping in to save First Republic. Can they do another one? The short answer is unlikely, right? So then, who else will be the savior? Will it be the FDIC? Will it be the Fed? Right? So there are more questions than answers right now. So really, I think a lot has to happen in order to really soothe market fears that this banking turmoil is really done and over with.
Han, let's leave it there. Thank you so much for your time. That is Han Tan, who is from Xfinity, taking us through the market reaction, of course, to that Fed interest rate announcement that we did get last night, 25 basis points. However, that is it from me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.